Yeah, absolutely. There should be a couple of more that will be signing on. I know somebody just sent me a message saying that she'll sign on at 11:15, which is 8:15
Hmm.
for us. But yeah, so there should be a few more, but we can definitely get started. You want to so Sydney is one of the co-founders of Black VC, and we met at some point early last year, and she's just been like super insightful for information, and I was just glad to be connected with her. So Sydney, you want to just give a little intro on who you are?
Sure, I will. So like Charles said, I'm one of the co-founders of Black VC, which is a nonprofit focused on supporting Black investors and increasing diversity in venture capital. Um, Started that about 4 or so years ago when I was first working in VC at NEA, which is a large generalist firm. I was largely focused on early-ish consumer investing. I was there for a few years and then did a quick stint at a small business that worked on wedding invitation companies, worked on wedding invitations. Um, then went to a fashion startup that was about a Series B. I was there during the Series A and the Series B for that company. So about somewhere between probably 120 to 200 employees. Um, and now I'm refocusing my time again on investing. I am a scout investor for Lightspeed, which means I invest on behalf of them as an individual. And I also angel invest. So my angel investments will tend to be on the smaller side, more of a bet on a founder or an idea, as small as like a 5K check or, in theory, even smaller. And then my angel investments tend to go up, or sorry, my scout investments tend to go up to about 50K. So still not the largest angel checks, but I try to do a fair number of them. My background, as you may have seen, was largely in consumer bets. So, uh, consumer D2C or consumer tech, things like that, but also really interested in marketplaces, B2B2C companies, a lot of that stuff. The earliest company I invested in was kind of like First Check In, and then the latest company was like a Series A. So I've done a little bit across the board. That's kind of my overview. I'll get into a little bit more of my thoughts later, but we'd love to start with a round of intros. Um, Maybe we could start with Brandy, and then she can popcorn it to someone else just so I can get to know you guys and provide some more specific advice.
Okay, Brandy. I am the owner of BJ Thomas Consulting Group, which is a diversity and inclusion firm. I've worked with Charles in the past at BNY Mellon. Just connected what him said. Does he need any help with anything after we were just, um, catching up? And then lo and behold, he came up with this idea, and I've been working with him since then. And I'm just helping to coordinate and help him get this off of the ground. We'll go ahead and let's pass it to Wakina. Is that how you say it?
It's Wakenya. Good morning.
Wakina, sorry.
No worries. Good morning, everyone. I'm super excited to be here. I'm Wakenya Clanton. I'm the founder and CEO of Akoko. It is a life, leadership, and business performance coaching app that we've developed in 2020. The app is designed to connect millennial leaders of color to coaches in their respective areas. And so we're super excited. We have our MVP developed, and now we're preparing to go to market with it, and also further our coach recruitment process. And so super excited about being in this accelerator so that we can make sure that we're making all the right steps. And thank you, Sydney, for being here with us this morning. I have to popcorn it. I'm going to popcorn it to Carolyn.
Thanks, Virginia. Good morning. I'm Carolyn Pitt. I am the founder and CEO of Productions.com. We are the job marketplace for productions, and we connect music labels, corporate brands, and studios to vetted local crew. And while we advocate for production professionals of all backgrounds, we are very intentional about leveling the playing field for women and professionals of color who are very underrepresented in the industry. I'm based in Atlanta. Georgia's the busiest production hub in the world. Sydney, I had a chance to hear you speak at Afrotech in 2019. I'm excited about the work that you're doing and excited that you're here this morning. And I will pass it off to Jasmine.
Hey guys, Sydney, nice to meet you. I'm Jasmine Maeda, founder of Round 21, which is a lifestyle brand at the intersection of art and sport. Simply put, our mission is to make standing out the new standard for this outspoken generation, because we believe what you play with should say something about who you are. I'm gonna hand it to Valerie.
Hi, Sydney. I'm Valerie Biggs. I'm with NetHub. We provide an online network of registered professional organizations to help students find their career passion. I'm excited to hear more about your company, and yeah, that's what I got. And I will pass it on to Belle.
Am I unmuted? Oh, I am. My name is Belle Hernandez, and I am the founder and CEO of Latin Heat Media. We're a multimedia company providing media content on and about Latinos, and we deliver that through editorial, TV, film, and online web content. And I will pass this on to Shelley.
Thank you, Bill, for the assist. Good morning. I'm Shelley Wilson. I am the founder of Platform in Development, Sports on the Lips, where we connect underserved collegiate women athletes to that first experience, internship, mentorship. The platform was inspired by my love of sport and my own trajectory into the sports world. I backed myself into a career in sports marketing with NASCAR, and have been on a road, a fast track ever since, to bring along some more women.
Shelly got a popcorn it.
Passing it on to Joche.
Thank you, Shelly. Hi, everybody. I'm Jose, originally from Ecuador, now based in Brooklyn. I am the founder of AirPulse, which is the evolution of the B2B logistics marketplace. We are bringing the hustler approach to AI to fill in the gap in B2B short distance shipping. And I will pass it to, let's see, Alexis.
Thank you, Joche. So my name is Alexis. I'm the founder of DentQuick, which is a networking platform that helps dental professionals connect, work, and hire. We think of it as LinkedIn for dental professionals, as well as we added in the Uber in that they can request, dental professionals to work for them on a temporary on-demand basis in the same way that they would request Uber. I'm a dental hygienist, and so I was able to see all of the different issues that came up when it came around that space of hiring dental staff. So I wanted to break that that barrier there so that all dental professionals could join in one place, network, and find some really great staff members to build great teams. Thank you. I think it is Kim, if I'm not mistaken, still needs to go, right?
Hey there, Sydney, sorry, I have to shut my camera off when I'm speaking. Zoom is really crazy, but so nice to meet you. I'm Kim Evans. I'm the founder and CEO of Just Her Rideshare. We are a peer-based rideshare company with women drivers for women riders. We are based in Charlotte, North Carolina. And I'm so excited that we now have a living, moving, breathing app that we are testing in beta, and so excited to be here. I am a social entrepreneur, so we are building out a community port on our technology that will be a place where women will be able to engage and connect with one another, and we'll talk about some issues and offer resources. And so we're all about community. And so again, thank you so much, and it's so nice to meet you.
Why don't we have Sandy go?
I have to popcorn it. I'm so sorry. Let's see, Tandy.
Hi, so my name is Tandy. I am one of the co-founders of Skintress, and we're focused really on increasing access and care satisfaction for people of color in dermatology, for patients of color in dermatology specifically, and we're leveraging telehealth to do that. We're currently pre-seed and working on our MVP. I think being in the health space, like you're always working on your MVP, it has to kind of be perfect. And I'm still like early in my career, but my educational background is really in translational medicine, which focuses on commercializing technologies and addressing needs or gaps that exist on the bench or on the bedside. And Adonica, I don't think Adonica went. Or did she go?
Good morning. My name is Adonica Shaw, and I'm the founder and CEO of Surrender Circle. We are currently building the Wing Women app, which is the first peer-to-peer social wellness app with HIPAA-compliant messaging and telehealth services for professional women. I'm also based on the West Coast, so excited to have you here with us today.
And Dr. Kiki, if you can do a quick intro.
Hi, good morning, everyone. I am Dr. Kiki. I'm an osteopathic physician, and my business is focusing on providing mental health resources, services, and support for female physicians. Physicians that have suicide greater than any other profession, and female physicians that are greater than males. So my project is to first build the community, and then have the community build out the tech. And I launched my podcast this month, and also my network, my community for the physicians. Thank you for being here today.
Oh, of course, did anyone not go? Awesome. Well, so lovely to meet all of you. You're all working on something really interesting. A lot of you seem to be taking on issues that are relevant to your personal lives, your past experience, which is always, I think, something that fuels a great service and a great idea. I gave you a bit about my background. I'm just going to be talking a bit today about cash flow management, staying lean. I'm going to start probably just do about 10 minutes, maybe 15 minutes of just tips and overall thoughts. And then I'd love to jump into some Q&A. So if you guys can start thinking about the questions you have, the questions you'll have in the future, I think that's going to be the best way to spend most of our time. So just to start at the high level, so one of there are a few things that are much more important than anything else to spend money on. One of which is great employees, and the second of which is tools that empower your great employees. So at the end of the day, most of your businesses are going to be a lot about the people who you bring on early. That's going to be the differentiator from your competitors. They're going to be the people who support you. They're going to be people who allow you to take what's in your head and put it out into the world. So you don't necessarily want to skimp on people. If you find someone that's really great, or if you know what the market's paying, a lot of times that means you need to, pull out the checkbook and really make it happen. Sometimes that will require venture funding, or if it's early on, it really will be about being able to convince someone that what you're doing is really important. So finding someone who's maybe in the same space as you or is willing to take equity. But you still want to be smart about that equity, because whatever you're giving out now is something that you won't have later or will affect what you have later. So that's really big. And then the tools that empower great employees. There's going to be a lot of time you'll need to spend on this, but you guys have each other. So using each other as a source of advice, I think, is really important to try to figure out how is the best way to run my business? What are the tools that will really make me successful? And then I think the last thing is the technology. I've definitely seen this being a pitfall with early stage founders. They have an idea, they really want to build it, but they're nervous about running out of money, or they're nervous about investing a lot into a company before getting an investment. And so they go to a VC with kind of a product that they either haven't tested, or they just have the pictures of it. They don't have an actual demo. It's really important to be able to test out your idea and bring it to life. And if you don't have enough confidence in the idea to spend money on the MVP, the minimum viable product, then it's going to be hard for an investor to garner that faith, especially if they can't see what the product actually does. Another thing that's really important about investing in technology is being able to get the thoughts of potential customers, to be able to put betas out there and see what makes a difference. So if you have the tool that one customer can use and they can test it out, maybe then they decide to become a paying customer. And that's a more sustainable revenue down the line, instead of them saying, okay, well, you don't have a real product, then we're going to do an unpaid beta for a year. And then it just puts you in a position that it makes it a lot more difficult to have negotiations, to convince customers, to convince VCs, and to convince employees. So those are kind of the 3 top level ideas that I think about a lot when it comes to money. Where are the good places for you to run lean? Right now, of course, office space, but even in general, I think that's a big one. It's really easy to get suckered into the belief, especially, 2 or so years ago, that you need the fancy office in Silicon Valley next to all the other entrepreneurs. But you can find great office space in other locations. I have an entrepreneur I just invested in who's currently in Salt Lake City. She used to be in the Bay, but she's not sure exactly where she's going to go. So she's kind of just, taking a temporary space, and they're doing it all virtually, and it's working really well for them. That becomes a lot harder if your product is more physical. Say, for example, you're selling technology for fitting clothes or something like that, or you're selling a new type of fabric or material. You kind of need to be near those manufacturers that you're selling to if they need to feel and test the product, and they're going to want to be with you in person, or if there's some sort of like frontier tech or heavy technology, then you're going to want to be in person. But where are your customers actually? Are your customers actually in Silicon Valley, or are they in the manufacturing centers in LA? Or are they, in Atlanta, like I think Carolyn mentioned? That can be really helpful if you do need to be in person and if that industry works that way. But that doesn't necessarily mean you need to spend a lot of money on a fancy office before you have everything else figured out. So thinking about where you can be lean there. I think we talked about taking care of your employees. In my mind, that's, tools for success, insurance, things like that, things that make your employees' lives more, better, make them more productive. Is that yoga classes every Tuesday? I don't know. Or is that the candy bowl in the office? Now, these are small expenses that we're talking about, but think about what really makes your employees' lives easier and what makes them more productive, and not just things that'll make them kind of short-term happy. The other big high-level thing you want to think about is just your burn overall. You want to be able to justify your burn, because you're going to have to, that's going to be a really early question if you're going to VCs or if you're going to banks. How much are you spending? Why are you spending that much? What is it going to? What is your burn going to look like in 6 months? So it's not just about the temporary short-term burn and what you're spending right now. It's about your plans for spending. How does that reinforce your growth? How is that justifiable? How does that compare to others in your industry? We think about when I'm thinking about burn with a company and whether it's reasonable, I kind of have certain numbers based on employee averages in the regions they're in. How many employees will they have? And that I consider to be the largest expense, and will likely be for you all as well. But the most important thing is knowing at any time what your burn is, not having it fluctuate a ton, but kind of being steady and expecting your expenses. And therefore, when you have steadier expenses, you can pay for them in a more systematic way, rather than, we've all seen this with credit cards or something else. If you need a one-time very high loan versus, looking for credit over time, that's going to look different, and that's going to be a different expense. So just thinking about your steady burn, and then also outsourcing things where they're possible. So I don't think everyone here is going to be a engineering expert. I'm not. I don't know how to code. But there are lots of ways to outsource that. But you want to make sure you're doing it in a smart way. So maybe you don't need a head of engineering who is consulting for you from Google or wherever. Maybe there's a lot of great outsourcing technologies from different countries, from China, from Eastern Europe, that can help you build a minimum viable product before you get to the tax savvy part yourself, where you bring on a head of engineering or a CTO. So being very smart about that. And then there's other things, of course, you can outsource as well with hiring. There's so many platforms that you can put out there, and bringing on help there. And then the last thing I'm going to talk a little bit about is revenue. I think revenue in VC is probably the most important factor. VCs are looking for growth. They're looking for sustainable revenue. They're looking for a plan in terms of what you're going to do. How are you bringing in long run customers? So say you are doing your first bit of selling, you're trying to bring on that first customer. It's okay if you say, I'm going to offer you a year free of the subscription, if you're then also making money on the commission. Otherwise, you don't want to give customers this really long period of free product where they kind of are able to find time to find another service. Other competitors are given time to come into the space. You want to do what it takes to lock in a customer early, make sure they're either dependent on you or they need you or they get used to the system. And then you want to start generating sustainable revenue as soon as you can. I also think a lot of times if you're doing an unpaid pilot or an unpaid beta, it can be really hard to get a sense of what your customers will actually do when a paying product comes up, when you require them to pay. And then also it kind of sets you up to this unsustainable path where if another competitor comes in the space, you say, I'm willing to drop my price again. You need to kind of set a standard that makes sense. So is your rule, first 6 months of subscription for this product are free, but you pay per use or per commission? Or is it something that each customer pays for maybe not the first use, but they pay for the second use? But just kind of having a system there that I think is really smart. Tanny just put a question in the class. I heard you should always do a paid pilot. I generally do believe that, unless it's something that is really expensive and there's another way of getting money. So this example that I'm talking about is a company that is a marketplace for businesses. And so they help connect businesses to individuals through a marketplace. And they basically said, we'll give you the maintenance for the subscription free. That would normally be, a couple thousand a month or a couple $100,000 a year. But you're paying commission per customer that you bring on through our marketplace. And that proves the use case. That also gets them used to the expense, but also starts showing immediate benefits for them because they're bringing in revenue from your product, but it's not 100% free. So yes, I believe paid pilots, paid demos, things like that are the best you can do. Of course, if we're talking about very consumer oriented things, that's different. Don't give away your product for free. Don't get your customer used to an unsustainable price point. And also think about what that customer is going to want in the long run, because price point is a really important point to consumer that you don't want to overlook and kind of pretend that it doesn't exist. An example of one of those products is if you look at Blue Apron and Green Chef and all of these companies, they're great ideas. But from the beginning, they catch you with these flashy ads that say, 10 free meals, 20 free meals, or first month free. And then they have this problem with customers that just churn. They go from one service, they go from Blue Apron to Green Chef to Sunbasket to whatever's next after that. And they've had a really tough time sustaining that growth. Okay, great. Let me see if that's everything I had on my list. Okay, the last thing is when you go to look for funding, you're going to get asked questions about your customers. And I've had a lot of startups come to me in the past and say, we have, X many signed letters of proposal or contracts. That's great. It's great to start getting interest. And if you have a lot of that interest, that can really move the needle. If you have one, letter of proposal or one, unsigned contract, or similar to how if you have one unpaid pilot, it doesn't mean a lot. It doesn't necessarily mean that you have customers. It means you have interest, but it doesn't necessarily mean that people are willing to pay for your service. So coming to a VC when you have a signed contract, a signed letter of intent that shows, a trajectory for revenue, that can be just as good as coming in with actual revenue. But you need to have that plan. You need to have customers that demonstrate an interest in using the product. In order to demonstrate something that's viable. So I would say, if possible, you should really only go to VCs once you have some revenue that's been proven out. Okay, great. Let's stop there temporarily. Does anyone have any questions, or does anyone have any issues that they've been dealing with or thinking about with respect to burn, cash flow, revenue, any of those things?
I have one question, and I think I'll just get it out of the way now because I think I might be the only one that holds inventory. But the fact that you said invest in the people and the tools related to an inventory business, I just wanted to get any principles that you may be able to share generally before we go into what is probably more applicable around subs and recurring revenue for the team.
Yeah, that's a really tough question. The challenge with inventory is obviously the more inventory you order, the cheaper it gets. But you don't want to be stuck with something that doesn't work. I think generally I'd advise start in small quantities to test out what works. And that's generally how I think about kind of an angel round or something like that, is I expect, or a friends and family round, I expect the entrepreneur to still be trying to figure out what works, and they're trying to test things. They have a few ideas, they've seen some response in the market, but they don't know who exactly is their customer. Is it the mom or is it the child? Is it the CTO or is it the head of HR? So putting in enough resources in the inventory to test out multiple ideas and see where you should be putting your money, I think is a really good way to think about it. And then doubling down once you feel pretty confident. I think that's important because you do want to demonstrate that demand. One challenge I've seen in the past was I met with a company that, interesting idea, had only ever sold out of products because they had only done small quantities. And that was really hard for me to indicate the demand because, like, yes, it's great that you've shown this traction, but you sold out of 100 units. I don't know what that means when you buy 1,000 or 2,000. So I think starting early with something like 100, but then you don't want to do 100 twice. You want to do 100, and then you want to really double down where you saw the emphasis going and where you saw the traction generating. Is that helpful?
It is. I appreciate it. I have some nuances with limited edition scarcity is actually the hype.
Yeah.
But the evergreen product that needs to be margin rich kind of is always on. But the thesis you shared was applicable. So thank you.
Yeah. No worries. I worked at a company that also had a similar situation where there was some limited edition products and then the most of it was evergreen and everything else. I think you should the other thing to prove out with numbers, I didn't really talk about this since we were talking about cash flow, is really about engagement. So what are those limited edition products doing for your business? How many new customers are they bringing in? Not necessarily in terms of revenue, but just in terms of eyeballs. And then what is that doing for your bottom line? So I definitely understand the nuance there, but I think thinking about those engagement numbers, and the same thing is true for enterprise products as well, is like how much time are your customers, employees spending on the product? How much are they engaging with it? That's a really great indication of what you can do down the line.
I have a question. So our business is B2B to C, although technically I would say it's more B2B and B2C just based on how we're going to phase it into market. I'm actually going through my deck right now, and I'm wondering if, in your experience, if it makes more sense to prioritize hiring like salespeople. So for example, if you're trying to get the product in front of HR managers to get those, even if they are just assigned letters of intent or whatever, or if it makes sense to really focus on product first and then roll out the B2B model after you actually have got consumer feedback and you've got some traction. I'd love to hear your thoughts on that.
Yeah, that's a really good question. And I deal with this a lot with my founders. Because on the one hand, you as the CEO, as the founder, are the person who knows the company the best. And you should be able to sell the product because that is a lot of what you're going to have to do to bring on investors, to bring on early employees, to bring on partners. So I think it's really important for you as a founder to take a large role in selling. That being said, most of you don't have a sales background. Most of my founders do not have a sales background. And that's not who I want them to be down the line. I do not invest in them because I want them to be the head of sales and I want to bring in a different entrepreneur as the CEO. I want them to be the CEO and I want them to bring in someone with a great sales background down the line. But I think early on, it's really important to get that product right, to bring on that head of tech and engineering, to bring on those people who can make sure what you're putting out in the market works. And then later to bring in a great head of sales or a great salesperson. And part of that is because I think the entrepreneurs the entrepreneurs who are successful in the long run tend to be really good sellers in the early days. They just know their product, they know how to sell it, they know how to put boots on the ground. That's obviously a lot easier if you're coming from that space than if you're not originally in the space that you're starting a company in. But I think probably the first year or so, expect the entrepreneur to basically be the head of sales as well. But I also don't want that to be the long run plan. I've definitely, when I'm talking to all my entrepreneurs, I say, hey, like you're great at this. That doesn't mean this is what you should be doing down the line. Like you will find a great head of sales who has experience in the space, who knows what they're doing. So to answer your question at the high level, I think early days, putting emphasis on the product, finding out what works, figuring it out is really important because then you're going to generate word of mouth. You're going to make it work. The other thing is it's really hard to sell a product that's not great. But then down the line, you should definitely be thinking about who is the best head of sales, who has relationships in the space that I'm working in, who can, really gets the product and can sell it the way that I would, allowing me as an entrepreneur to focus more on the broader vision of the company and piece everything together.
Awesome. Thank you.
I have a question that follows on pretty neatly subject-wise with that. It has to do with burn. And I heard you mention being able to report burn not only now, but maybe 6 and 12 months down the line. So ordinarily, when I mention burn now, most of our funds have gone towards development. However, as we grow and expand and scale, definitely there's additional FTEs and other marketing, et cetera. I wonder if you normally advise your founders to offer that 6 or 12 month burn or to wait until an investor asks. And the reason that I'm asking that is because encoded within that could be how much are you paying yourself and other team members. And that's just something that I'm always really thoughtful about. So love your thoughts on that.
Yeah. You can definitely wait till an AVCS. The numbers I look for in a deck tend to be numbers about growth and engagement and traction. So how many customers do you have? How has the number of customers grown? Where do you project it to go? How much revenue does that correlate to? If it's something where you might have, some sort of the half paid pilot, like we were talking about earlier, some sort of discount for early customers or something like that, then talking about what the commission looks like or what the revenue looks like based on number of products sold on your marketplace or number of customers you bring in. That sort of thing is what I look for in the deck, as well as customer acquisition costs. So those would be the only costs I would really expect in the deck. It's like, what does it take for you to bring a customer in? How much time, how much money? In terms of burn, I'm probably going to be looking mostly at your burn today. So, that's going to be spent on employees, including yourself. That's going to be spent on services, offices, things like that. But then I want to know in 6 months when you're doing this fundraise. So you're going to be bringing on, let's say you're going to be bringing on 3 employees, and one of which is a head of marketing, CMO, another is going to be a head of engineering, another is going to be, a software engineer. and then you're going to be moving to a new office, or you're not, or you're going to be, taking on this new approach or this new technology or something. What does your burn look like then? What does that customer acquisition cost look like in 6 months to a year? Does it increase? Does it decrease? Those questions, I think, are really important for you to identify. And that's going to kind of all be in the financial projections about your growth, your spending, all of that. Does that answer your question?
It does. Thank you.
I have a follow-up question regarding the same topic. So I am going back and forth with this investor. He's a risk manager at the bank, so I understand where he's coming from. But in my financial projection, of course, he can see that we're burning a lot of cash, right? And we intend to open a seed round next year. But I get this feeling that he doesn't want us to keep raising money. Of course, it's not my first option. My first option is getting revenue from the customers, which we are doing today. But in order to grow and scale and reduce the cost of the operations with the technology we're developing, we need that cash. So I don't know how to navigate that conversation. I think he is, I'm hitting a wall with him. So I would love to have your thoughts too.
That's really tough. I think personally, not having the full context, I think you're in the right. When you're going to raise VC, when you're starting with a seed or an angel round, the expectation is generally that you will need to raise money to get to profitability. And a lot of times I don't expect a company to get to profitability until Series A, Series B. I mean, like again, we said Uber's still not profitable. That's not what I recommend. I think you should need to have a path to profitability. So if, say, right now, let's say we're talking about a consumer good, you're selling lamps, and your lamp costs $100 and your customer acquisition cost is $40, and your cost of goods sold is $70, and we're getting to $110. Is the plan for this fundraise to cut those COGS in half? Is your plan for this fundraise to cut that customer acquisition cost in half? Is your plan to somehow raise the revenue? There needs to be a path that says this is viable. And frankly, I think it's really, really tough for me personally to invest in a company that doesn't have positive unit economics. Where I generally see companies coming into a lack of profitability is because they are growing the team, or they're spending money on these kind of fixed costs. But if they increase the units, then the unit economics play out to be profitable in the long run. I think that's really important to see that path. In terms of explaining that to your VC, that would be how I would focus. I would focus on the unit economics. I would focus on when you're able to turn the business around. I'd also focus on the different scenarios. So if we put 100K into this business, what does that look like? When does that turn into profitability? If we put 500K or $1 million into this business, does that speed up when we're able to be profitable, and how much money we need to take down the line? Because if you take on 100K now to just get you through the next 3 months, and then you need to raise again, you're going to be raising at a lower valuation. You're going to be raising at less favorable terms. And the business is going to be on a less sustainable path. The other thing that's really important for founders is you want to be starting your fundraise with a fair amount of money in the bank, because if you start your fundraise when you have 4 weeks left of burn, or even 2 months left of burn, or runway really, you're going to be feeling a lot of pressure to take whatever money comes your way. And sometimes you're going to meet a VC that you're like, we just don't jive. Maybe I've gotten bad references on you. Maybe we just don't have the same vision, and I can tell early on. But you want to avoid, where possible, having someone on your cap table who has different expectations of the business from what you have. That's not always feasible. Sometimes you're going to need to take the money that comes your way. But if you start fundraising with about 3 months to 6 months left, if not more, of runway, you're going to be able to be a bit choosier. You're also going to have that option to start the fundraise, realize, hey, I'm having a really tough time fundraising right now. go out for another 2 months and just try really hard to get those customers or that traction that move the needle. And then you can possibly double your valuation because you're able to show the investors what they were looking for rather than giving away more equity now because you're raising on less favorable terms or raising from a less favorable position from people you don't work with as well. So just trying to put yourself in a good position when you go out for the fundraise, I think will make things a lot easier for all of you. That being said, if you're having trouble with people on your board, that's always going to come up. There's always going to be some tension there. And I think it's about having those clear paths of communication. What are your expectations? What are my expectations? What do I see as the challenges of the business? Just kind of trying to have those conversations. I was talking recently with someone and saying, the type of investor you want on your cap table is someone you can text and someone you can call with any question. That's tough to generate that relationship. But I think you got to start it early and that'll make things easier down the line. The other thing to consider is this isn't necessarily true, but you already have their money. So you need to be confident that they believe in you and that they put their faith in you to build this business. And just having that confidence that you have more answers than they have. A bit of a tangent, but hopefully all of that was a bit helpful.
Yeah, thank you so much.
Okay. So we've got one question in the chat. Tandy, do you want to read it out loud?
I think you kind of answered it. I don't know if there's other, but I'll read it out loud. I don't know if it might help to go over some other parts of it. So when you see a financial projections in a deck, what are some of the numbers you want to see? And I think you kind of addressed that with Carolyn. But I was thinking specifically, I've heard that you should have your revenue, gross profit, net profit, gross margin, and then a KPI that one of your most important KPIs or two of your most important KPIs. But then also I've been doing some more research and I've seen people say you should include your cost of sales or operating expenses or the head count of employees. And I'm just trying to figure out how much of your financial projection should you include?
That's a good question. So there's a difference between your total financial projections and what's going to go in the deck. In the deck, I'm really looking for 2 to 3 KPIs and your revenue growth projections, unless your profit is incredible right now, or that could be in your KPIs. So for example, I recently invested in a company, D2C hair care company, and they had great, I would look for from them as well as from other customers, your lifetime value of your customer, or if you don't necessarily have enough number based on, if you don't have enough information based on how long you've been in service, then what are your unit profit? Or unit revenue, that would be average order value or something like that. So lifetime value or some equivalent. I look for customer acquisition cost, and COGS, depending how you want to put that in there. Some people put customer acquisition cost and COGS together. Or COGS would kind of be the last one that would be a little bit more optional, but lifetime value, customer acquisition cost. Then I want to see revenue growth. Where's your revenue today? Where do you expect it to be in 6 months? Where do you expect it to be in 3 years, 5 years? Then if the conversations are going well, generally after the first conversation, I'll probably ask for a data room. That's where I want to see full financial projections. What is your burn rate? What are you spending per month right now? What's the revenue? What's the COGS? What's the customer acquisition cost? How does that vary for repeat customers versus existing customers? What does that mean for full-time employees? What does it mean for marketing, advertising, other expenses? I expect to dive into all of that a bit deeper, kind of later stage. But I think the most important things to show early on would be first level in the deck, 2 to 3 KPIs. Second conversation or, first email, I'm looking for other KPIs, other, unit economics, especially, or if it's B2B or if it's B2B or B2B2C, then I'm looking for lead time and how long that takes. And then the last, kind of later stage where we're really getting into it and we're really getting close towards the investment, those would be the full financial projections that I'd want to dig through.
Can I clarify one thing? That's great. So in the kind of handshake to this potential investor, you want to see some of those KPIs, or is that more, I don't know why I had maybe assumed that, at least in my experience, and maybe this is why I'm still raising money, is first gauging just mutual interest on the intention of the business before like disclosing all of even early KPIs. I don't know. What are your thoughts on that first handshake being more just introductory?
I've heard this from entrepreneurs as well, and it depends a little bit on the business, but 9 out of 10 businesses, I would say I kind of need to see KPIs up front, at least 2 to 3 of them. Whether that's user engagement, number of customers, retention rate, that can be a great one. Choose your best KPIs and put them out there because you want to convince this person that this matters. If you have a very high tech business, that would be the only situation where I would say you don't necessarily need to include any numbers up front because maybe the business isn't fully there yet. Like say you're talking about, but then you would still want to have some other numbers. Say you're talking about like space tech or something like that. You don't need to say how many customers you've had, but I need to know why your product is very, very different from what's out there. This is also true for B2B. If you're coming up with a Salesforce competitor, I understand that Salesforce is a big business. I just need to understand, why are you better than Salesforce? Why would someone choose you over them? And the answer is either A, customers are already choosing me over them, and that's why I can show you growth and revenue and other great unit economics. Or the answer is B, the one demo I've done with someone, they spent 7 hours a week versus when they used to spend 15 hours a week on Salesforce, or the reverse. They spend so much more time with our product because they love it, or they, are able to be 3x more productive. We've taken the lead gen time of our customers, cut it in half. So you still need some data in there, I think, unless it's like extremely technical. Here's another example of when you might not do this. I recently met with a company that's focused on diagnostics. So they're kind of in the healthcare space, kind of in the consumer health tech space. And if you can demonstrate that there's some kind of need there, if you can say like, we're able to find, 10 points of data that would normally take a 2-hour hospital visit, and we're able to do that in 20 minutes. That's pretty helpful to know. I'd still prefer to know some revenue or some projections or some estimate that hospitals actually want this or people actually want this. But that engagement data or that tech data can also be pretty helpful. But I think you need to have some proof of concept that what you're doing is valuable to the people you want to sell it to.
So the KPIs are more like the validation that you're showing, right? Like when in your pitch deck.
Yeah,
Okay.
I would say it's the validation. It's also the hook. I think there's a lot of great ideas in the world. And frankly, there's a lot of overlapping ideas in the world. And so you being able to come in and say, yes, you've seen 3 digital health companies, or you've seen, I've seen a ton of this. I've seen 5 QuickBooks for contractors or freelancers or something like that, really probably in the past, 6 months. But who has the customers? Who's proving it out? And you can say, I'm taking this nuanced approach or that nuanced approach, but how do I know that the market actually needs that nuanced approach? How do I know the market wants a competitor to Salesforce unless you show me that that's there?
Thank you. That was really helpful because on my slide decks, I got one of my mentors to review it, and they're like, okay, your pitch deck is great, but where's the validation? So I think that was really helpful, framing it the KPIs, because I was a little bit struggling with that.
Yeah, that's a great validation would be numbers.
Hey, Sydney, I have a quick question. So when you mentioned about you wanted to look at revenues, and I mean, I feel like when I'm looking at startups and looking at their deck, and their first year, they may they probably have revenues of around 200,000, and then the next year it's goes up to 10 million, and then 50 million. So it's what exactly are you basing, when you're looking at revenues, are you basing it off of like total addressable market, or like, like 10% of like addressable market or something like what are you suggesting for when they're basing off that?
Yeah, that's a great question. And that's exactly what I think when I see one of those graphs. And my first question when I see one of those graphs, actually my first two questions, my first one is, how many customers is that? So if you're going from 200K in revenue now to 1 million in revenue next year, or 5 million in revenue next year, how many customers are you going to need to get? How many customers are you going to need to retain? I think that's something that's really important, because if they say, well, I have 10 customers now, and this is with 5,000 customers. Okay, then that follows up with my second question. What's your run rate right now? How many customers did you do last month? Or how many sales did you do last month? So for example, I saw this company that did 2 million in revenue last year. Really, really great. But their December, they did 450K. So that run rate is already, I don't know how you do the math, but that's like 5 million run rate. So they did 2 million last year. But if they say they're able to do 10 million in revenue next year, maybe that's a little bit of a bet. But if they keep at their current rate, then they're going to be at 5 million. And I'm expecting them to grow. So run rate is a really good, you'll sometimes see that in people's decks. Instead of revenue, you'll see run rate and repeat revenue. It can be, depending on how they're actually putting it, it can be a little bit tricky. Did you have, one 12K day and 10 0K days, and you're taking that 12K day and you're pushing it out? But if I see a monthly run rate, I tend to believe that to be true. But pushing that and expanding it out, I think is really impressive. What I don't want to see is a number pulled out of your butt. I don't want to see you saying like, I expect we'll have 10% of the market next year. Like, why do you expect that? Like, where did that number come from? Like, I rarely would do it in percent. If it's in terms of customer, then you can say, I know how much time it takes me to acquire a specific customer. Or if it's a consumer product, you can say, my customer acquisition cost right now is $30. If you give me 300K, I'll, put that 300K and whatever the division is, 300K divided by $30. And that should technically get you to how many customers you can bring on. And then you can say that. But there needs to be something backing up that number that's based on what you're doing today. Cool. Anything else? Any other questions?
Maybe this is just a little bit off the subject a little bit, but do you have any resources that can kind of help founders maybe understand more of kind of the key terms that you're mentioning, customer acquisition or lifetime value? I know I've seen it, but sometimes it's a little bit hard to really okay, how do I break this down and apply it to my business?
That's a really good question. I think there's a lot of different resources online, especially in terms of pitch decks and things like that. Just Google, great pitch decks in X Space or something like that. In terms of it's going to be a lot easier to find some of those numbers and understand them for consumer businesses. So for example, if you just Google lifetime value or customer acquisition cost, there's a couple really great models out there that just show different ways to calculate lifetime value and different ways to calculate customer acquisition cost. In terms of what are the good metrics and where to find them, that's such a good question. Let me, I'll try to look into it and get back to you. The other thing I would do is, if you have friends or people who have been entrepreneurs before who are willing to send you their deck, or if you can just Google and find some decks online, I will look through and just see what metrics they use, what acronyms come up, and search for that. I'll run through a few of them. So I've already mentioned CAC, customer acquisition cost. That's your basically marketing cost per customer that comes in. You can also do that based on conversion and click rate. Just Google that because that gets a little bit complicated. Lifetime value, LTV. So that involves retention rate, average order value, which is AOV. It involves, let's see, your margin, and there's something else I'm forgetting in there. Anyways, and then sometimes you'll see your LTV to CAC ratio. That's LTV divided by CAC. And that tells you basically how profitable a customer is, like how much value you can get out of a customer when you put a little bit of money onto the flyer. Another one, so retention and things like that. Yeah, churn rate is a good one. So churn would be the opposite of retention. That's exactly what it is, like how many people churn off the platform. Talked about burn rate. So that's like how much money you're spending per month, really. And that gets you into your not your run rate. There's a different term. But your how long you your runway is the word. Thank you, Kim. Runway, meaning how long you can survive. So if your burn rate is 300K and you have 3 million in the bank, you can survive for 10 months. Then we talked about your run rate, which is basically your repeat revenue. So if you did 3 million last year, then your run rate right now, if you did 3 million in February, then your run rate is 3.6. Did I say 3 million? 36 million. Monthly revenue rate, MRR, that would be the same as run rate. But you could have ARR, you can have MRR, etc. Let's see. I think those are kind of the big ones. Yeah, we talked about TAM, total addressable market, versus your TAM versus your total addressable market. Those I think are the same thing. MGR, monthly growth rate. Yep, that's great. Love to see growth rates. You have your like CAGR, which is what does CAGR stand for?
Compound annual growth rate.
Compound annual growth rate. Sorry, I just use so many acronyms now. I'm just one of those VCs. I don't even know what I'm saying anymore. But yeah, those are some of the biggest ones. But I think you're going to find the metrics that are really important to your business, and you're going to focus on those. The other thing I'd say is for entrepreneurs I talk to, one of the things I'm really impressed with is when they're able to see a trend that turns the business around. When they're able to say, when a customer comes into us through referral, they stay 3x longer. Or when we did this promotion, our retention rate for that cohort jumped from 10% to 15% over 6 months. And finding those numbers that really work for you, I think are going to be more important than just regurgitating the numbers that other people are doing in the market. That being said, you want to know what questions VCs are going to ask if they've seen customers or if they've seen entrepreneurs in spaces like yours. So if every entrepreneur is talking about engagement rate, like daily active users or percent of time or something like that, you're going to need to know the answer to that question. And if it's different, you're going to need to be able to explain why.
Thank you. That was super helpful.
Yeah.
Sydney, I have a question for you. I want to get your thoughts on it. So with our projections, like we wanted to sort of be very conservative because we are sort of a niche market. We're in a pandemic and we're a startup. How do you feel about being very conservative with your numbers versus, sort of over projecting? Because I have this feeling like if we're a conservative, like we're only trying to acquire 200 drivers within our first year. And we feel that we can outperform that, which would make us look really good that we beat our numbers. What's your thoughts on how you do projections based on how conservative you want to be?
Yeah, that's a really good question. I'm trying to think of how to phrase this. So one, I think the most important thing is being transparent with the entrepreneur about or with the VC about how you came up with the numbers, and saying, a lot of times I think entrepreneurs will do their projections mostly based on if they don't raise additional capital. So you can say this is based on the capital we have in the bank right now. And then you can also say, if we, have X more money, we could see this situation. When a VC is looking at projections and when they're valuing a company, they'll generally do kind of a best case, worst case base scenario. So a lot of times it depends on what the numbers are, but with entrepreneurs I've seen in the past, generally I take their projection as the best case scenario. Sometimes I'll take it as the base case if I think they're being really conservative. But that means then I'm kind of adding some sort of discount rate. So if they say they can have 200 customers in the first year, I'm going to say, what will happen if they only do 100? Or what will happen if they do 150 or 180? What does that mean for the value of the business? If a customer or if a entrepreneur is saying that their sorry, I lost my train of thought. If they're saying that their customer acquisition cost is going to decrease from 30 to 20, or if they're saying their lifetime value is going to increase, I'm thinking to myself, is that rational? What's the best case? What's the worst case? Best case scenario, your CAC goes down. Base case scenario, you've already gotten the low hanging fruit. I'm assuming you're going to have to spend more to acquire that non-low hanging fruit customer, that harder to reach customer. So that answer is to say, I think you should you should err on the side of being less conservative, knowing that your VC will probably take a grain of salt to it, but don't be ridiculous. Because if you're coming in saying like, I'm going to have 20% of the market, or if you're saying I'm going to have $5 million in revenue next year in a $50 million market, I'm going to be like, why do you think that? Again, like to what Charles and I were talking about, like I'm going to ask those questions and you need to have really good answers. I would, again, if possible, defer to your customer acquisition cost. So if you're going to acquire 200 drivers at $30 a pop, how much do you need to raise? I think that's a good way of thinking about it. I think the other good way to think about it is like looking at your existing retention rate and saying how many new customers will you need to bring on. It's more about having some rationale. But that being said, I would err on the side of what you think is really true. I would kind of push the numbers until you feel like, I don't know about that. Yeah, hopefully that's helpful. I know it feels a little bit uncomfortable because you're an entrepreneur, you have this business, you want to build it sustainably.
Yeah, well, I will tell you that there was some anxiety there because, this is sort of a new territory. And one of our competitive landscape, when we look at another company pre-COVID, this company was able to acquire like 6,000 drivers in the first year, 7 million in sales. But we're in a pandemic, we're a niche market, of course we're in a little bit of a different region. And so when I use that company as a part of my competitive landscape, I just sort of compare a little bit, but still wanted to be very conservative because we're in a pandemic, it's a niche market, and we're a startup. And so I would hope that investors would say, okay, be able to see the bigger picture and say, okay, if that's where you're starting at and your numbers look here or here, then I can see the potential and growth there.
Yeah, that's something that I've definitely struggled with during these times, because on the one hand, I am impressed with companies that aren't built for this COVID situation and been able to maintain some sort of sales. So if before COVID you were at 6,000 users a day and then you went down to 1,000 or 100 or something like that, and then you were able to build it up, it's nice to see that story. That being said, I am pretty sure that most VCs you go to and you say, this is going to be different post-COVID, I think they're going to say, well, then I'd like to wait post-COVID to see.
Right.
And I think the only alternative to that is having some sort of viable plan that you can execute during COVID that's kind of different. One company I saw that did a good job of this was in the corporate events space. And before COVID, they were really focused on in-person corporate events. And they were helping, a BCG or something like that, plan out their team parties or their annual conference or things like that. And then they really quickly pivoted to do online. And that actually helped them raise their round because the way they pivoted was really impressive to investors. And also it was meeting a niche need, but they also demonstrated that they could go back to that earlier need and that what they were building now was not just relevant during a pandemic. So that's a really impressive alternative. If you can't do that, I think being able to show, some sort of market trends or where the highlights are, like where are the engagement data better or something like that, just trying to find that silver lining that can turn things around is the next best alternative.
Sydney, I'm Melissa, founder of My Retreat. I've heard investors say that you can prove that you're really dedicated to your business when you quit your job and go full in, right? And my response to that is I am full-time in my business because I spend 35 hours a week on it, in addition to my 40-hour-a-week job as a therapist. My question is, where that leaves me is I believe that you have to make money to make money. I mean, I heard you say that you need to have money in the bank before raising for a round. And so I'm just wondering, with me bootstrapping and using crowdfunding and then my own money to fund my business, how I can accentuate and enhance those numbers of like client retention and just lifetime use, because my customers all stay and they don't go anywhere, right? And I think that that's great. And of course I need money to be scalable, or I believe I do. But I'm just curious how I can enhance that narrative around who's staying, what value, I have all sorts of qualitative information on why they value my product and why they would want to use my app instead of an app like Calm or Insight Timer.
Okay, so your question is kind of like, how do you use qualitative data to make a case? Is that kind of the question?
It is that. And then also, as far as retention of customers, I'm using very little funds to do that. And so, percentage wise, it's an impressive data point. But I want to be able to highlight saying with this amount of money, this is the growth that I've had.
Yeah. Well, I think the best thing about retention is that hypothetically, the idea of retention is I spent customer acquisition cost. I brought someone in. Look how long they stay. Look how long I can make use of that customer. So retention generally shouldn't be affected by, you shouldn't need a lot of money to increase retention. Generally, you should need more money to increase customers. So I would focus on that retention data where possible. The other thing is if there's something you've done that's changed retention. So say you've been in business a year, the first 6 months you had a 20% retention rate, and then your last cohort, your last 6 months of cohorts have had a 1 month retention rate of 30% or something like that. You can say that. Or you can say like this one specific cohort, I tried a new thing and that really worked. Or you can say that when, mentioned earlier, like when customers are referred by existing members, they have a 60% retention rate and I want to double down there. You can dig into that and there's nothing wrong with that. You don't want to hide your overall retention rate, but you can say like, here's where I've proven out what I want to do. In terms of qualitative data, that is a tougher question. I think it's especially helpful with more technical products. For example, B2B company, like if you have a salesperson saying like, this made my life 10 times easier than Salesforce, or like I used to use X, or especially a situation where a customer or an employee says, I tried out this product online. I loved it so much that I brought it to our CTO because and because I want our company to use it. And that can be your customer acquisition cost is bringing in one-off individuals, giving them a free trial with the goal of having B2B be your main sales pipeline. Those testimonials are helpful. The tough thing is there's no real context for testimonials or qualitative data. Like, for example, if you have let's say a sleep aid company, and you have a customer saying like, I, got the best sleep of my life, it got me off insomnia medication, this is incredible. But then I talk to them and I find out that you paid for them to have a, basically full-time therapist and, all of this expensive sleep technology or something like that. Like, you can't do that for every customer. That's almost not the same product. And yet maybe that's your demo to like test out your minimum viable product, but that doesn't necessarily mean anything. Versus if you're able to really show that you can scale something. And scale doesn't need to be thousands of users. It could be hundreds, it could be 800, but there needs to be some sort of trend rather than an individual qualitative data point. So I know that's a tough answer, but qualitative data just, I think it's pretty rare that it's able to compare with quantitative numbers. The thing I'll say in terms of the day job thing, I think, frankly, just like hide it for as long as you can. I don't generally ask most of my entrepreneurs, like, do you have a day job? If they're able to show traction, build something incredible, it seems like they're fully invested, they're able to convince other people to join their path as either employees or co-founders or something like that. That's impressive enough, and I probably won't ask. And if I were you, I wouldn't necessarily volunteer the information that you're working for another company. That being said, there will be a point in time where you're either bringing in enough revenue or you have enough conviction or you get enough funding that you would be expected to quit your job. I would never expect you to be a full-time entrepreneur, especially after raising money. But I would say just like, I don't think you need to bring it up unless you're asked about it.
Thank you.
I have another question. So when the things are not going as expected, what are the red flags that you have heard from entrepreneurs when they are talking about cutting corners in the budget or trying to, reduce the burn?
Yes. Okay, here are the big things. One is expecting customer acquisition costs to decrease significantly. That in theory doesn't really make sense. If it might in certain situations, but generally the first customers you acquire are probably the easiest. They either found you on their own, they found you through referral or something else. So if you expect your customer acquisition cost to increase, it means you expect your marketing dollars to be more effective, might be true. It means you expect there are more low-hanging fruit customers out there, maybe. But I'm generally a little bit suspicious of that. Another thing is the full-time employee average pay, depending on where you are. If you see a Bay Area person, especially in San Francisco, saying, I'm going to have people in person and I expect my average full-time employee to be 80K. That's kind of unlikely. It depends on who you're hiring. Are you hiring customer service? Okay. Are you hiring a software engineer? Where are you hiring from? Where are you finding a software engineer for 80K? Most software engineers in the Bay Area are probably earning like minimum 150. So that's somewhere I definitely see some corner cutting that, I have some numbers in the back of my head that I'm going to fact check that really quickly. Another area I see corner cutting, I've actually heard this from another VC, I haven't seen it myself, is entrepreneurs putting in VC funding as income, which is just confusing. So basically it's saying like you weren't profitable in December and then January when you raised $1 million, you were profitable by, 800K. That I would call corner cutting. Oh, here's another one. So when you have customer acquisition costs, you can have your paid customer acquisition and your unpaid, well, and then your blended. So blended accounts for customers that came to you organically, that you didn't spend any marketing on. Sometimes they will, just like their expectations of the way that customer acquisition costs will change based on the blended number will be a little bit inaccurate. The more marketing money you're spending, the less organic customers you're probably going to have in terms of percent, maybe not in terms of actual quantity, but just having a realistic expectation for what percent of your customers are going to be come to you organically. I'd say those are some of the biggest ones.
Awesome. Thank you.
Hey, Sydney, quick question around seasonality. So my mind is really racing around how I currently present my KPIs and some of the things you said. So again, I'm an inventory-based business. We're sports and art. And at least in the 1 year that we've been in business, the holiday outpaced the other quarters. And so as I look at Q1, although in absolute terms, I'm really excited about the revenue year to date, it doesn't feel like the startup trajectory in a clean, like straight line, but I know that's okay for a variety of reasons. And I know that the signals are all pointing to having another great holiday. So I was thinking about, and just to make it applicable more to the group, showing year over year growth, and then counterbalancing that with maybe website traffic increase. So there's intent or interest. Does that feel like a good logical approach?
Yeah, totally. From my experience in retail, Q1 is the worst time for businesses, especially January. It's a really tough month. I think year over year growth for any of you is a great metric to go by. It's going to look really high, but that's fine. I think if you want to then double down, you could talk about your run rate for, the average of last quarter. But I would say year over year growth is great. Focus on your customer metrics, use year over year growth to predict, say, your March numbers. And then if year over year growth, year over year growth is great because it works in any season and it prevents seasonality. So I think it's totally fine.
And do you think for this pitch deck with a few KPIs that it should be quarterly or monthly? Just curious your reaction.
I would expect monthly.
Okay, great.
Yeah, if your quarterly numbers are good, that's great. Okay. I would say monthly is really good, especially if it's a monthly average. Yeah. Okay, awesome. Joshe mentioned purchase frequency. Yeah, purchase frequency is great. So with the lifetime value calculation I was talking about earlier, purchase frequency can be one way to calculate it. You can do purchases per year, average order value of that purchase, expected retention, or not retention, lifetime. So that can be based on the churn. I think it's like 1 over churn or something like that. Please don't hold me to that, but you can Google it to find the lifetime period. And then you can figure out, that gives you how much a customer is going to spend over their entire period with you. So that can be great. Purchase frequency is also really good. If your retention numbers, it can help you figure out who your core customer is. If you have some customers that are purchasing 5 times a year versus others that are purchasing once a year.
Hey, Sydney, really quickly. So with have 2 revenue streams. So we have our business model is designed off of B2B and the B2C, because we have our end users who are our customers. And so that's our B2C model. And then we have our coaches who are our clients. That's how we frame it. And that's a B2B model. How do you recommend, I guess, narrating that in our pitch deck when we're talking to angel investors or any investors for that point, around just like how our revenue comes in and things of that nature?
Yeah, I've seen it a couple different ways. I think the most effective way I've seen it is, just speaking tactically, is sometimes like a slide that's like, here's who our customers are. So like, B2B, B2C, something else. And then it's like, here's some one or two key metrics for each of those. Here's the retention on the B2C side, the customer side. Here's the revenue or something like that on the B2B side. And then if you're having a revenue slide, a lot of times I'll just see one or two lines, 2 or 3 lines. That's like, here's the total revenue, here's the revenue just from customers, here's the revenue from businesses. So I think I think it's great. I think you just need to be able to explain why those two revenue streams work together and why they don't compete. Because sometimes you might have a VC say like, well, what if you just focused on this area? It seems so much more profitable. Or what if you, what if you have to hire 2 different salespeople for each revenue stream? And I think a lot of times the best argument to say is having a B2C portion is almost like a customer acquisition stream to bring on businesses, or getting more recognition through businesses means we have customers constantly looking for us. So we don't even really need to invest in customer acquisition on the individual side, because doing it on the business side works. I think you just need to be able to make that argument.
Awesome. Thank you.
Awesome. Anyone have any other questions?
This was great.
Great. Well, hopefully this was really helpful. If you have any other questions,
This was
please
more
feel
than
free to-
helpful.
Great.
This was more than helpful. Thank you so much.
It's so funny. When Charles reached out to me, I was like, this is so tactical. Like, I don't know how I'm going to help people about this space. Like, I'm not, because I think of you guys, the entrepreneurs, as being like the in the weeds people that I'm always so impressed with. And for me, I'm just like a high level person. So I wanted to give you as much of my thoughts as I could, but at the end of the day, you guys are going to find the numbers that work. You guys know your business way better than me, and any advice I give you will be less helpful than what you learn when you're on the ground doing it yourself.
Some of
We
the
need
most
that
important
person.
information, oh, I'm sorry. I was just going to say, some of the most important information is knowing what VCs are thinking, what investors are thinking, and what to look for.
I hope you're gonna put jacket on.
Awesome. I'm
And
glad to
because
hear that.
because we are the in the weeds people, we need the people who are seeing it at a 30,000 foot level, because sometimes we can be so deep into it that we miss out on the really important parts of it. So thank you for that.
That is true. Yeah, I think that is one advice I give to entrepreneurs is like, remember to come up, because VCs are pretty high level, and don't let the perfect be the enemy of the good, of course.
Yeah, Sydney, thank you so much. It's so interesting because I just like you mentioned when I was asking you to come on board, at one point she was freaking out. She's like, wait, I'm not really like, super technical. And she's like, and I was like, honestly, I said, a lot of these people are, kind of relatively early on, some of them are a little bit further than others, but I was like, any advice that you give them, I mean, I already know that, it's going to be amazing for them. So, you've already gave like a wealth of knowledge today. So I definitely appreciate this and appreciate you and your time.
Yeah, happy to help. Thank you for having me on. Feel free to reach out if you guys have any other questions.
Okay, so it's okay to share your contact information if they have questions and want to. Okay, great. So I'll make sure that you guys have that.
My one ask is that if you guys do email me, I love when people email me with specific questions so I can think about it ahead of us talking. I love to chit chat, but let me know if you just want to chit chat. If you want help on something, that's where I really get excited.
And also just be mindful of time too. Not everybody has a lot of time. So especially people like Sydney, who I'm sure, she focuses her time on so many different people. So
thank you. Well, none of us have enough time. So lovely to meet all of you. Yep, Charles could give you my contact info. I'm so excited for what you guys are building. Just like keep pushing through and you'll find where you want to get to.
Cool. Sydney, thank you so much. Appreciate you.
Thank you.
Thank you. Talk to y'all later.
Thanks. Bye.
Bye.
Thanks, bye.
All right. Hey, Brandy, you want to just let everybody know about the fireside and any info that they need to know about it for today?
Oh yes, fireside chat today with Lauren Washington. 3 to 5. Sorry, it's 2 to 4 her time, 3 to 5 our time. It's
Well,
on the
actually,
campus.
she has a hard stop at 4 though, right? It's not going to be till 5.
Well, 3 to 5 our time. She's an hour behind us from the East Coast. She's an hour behind the East Coast.
Oh, okay. Gotcha.
So yeah, so hard stop at 5 o'clock EST. How's that?
Eastern Standard Time.
Yes.
Okay,
Eastern
great.
Standard Time. So yes. So for West Coast, it's going to be noon to 2. Yes.
Yeah. So, and so sorry for like the last minute. Like we've been scheduling some of these people like weeks in ahead, and she was on the schedule. I think she was on the schedule for today, right, Brandy?
She was on the schedule for today. Actually, no. We ended up having to have a schedule change. A meeting came up. And then wait, sorry, I've been working with so many speakers. I might have them mixed up. No, she was on the schedule today, but she wasn't sure she was able to do today, and then she confirmed she could do.
Yeah, she confirmed last minute. So, but for anybody that is able to join, please hop on. So it'll be a great discussion. And I have a good friend that's going to be moderating it. And she's amazing. So I'll introduce her as well.
Okay, awesome.
All right. All right, guys. See you guys later.
All right,
Take care.
bye.
Later. Bye-bye.
Thank you, guys.